What if I told you the U.S. economy is slowing, but inflation is still lingering, the job market is softening, and consumers are pulling back? The numbers just came in, and they paint a picture that's more complicated than most headlines suggest. Let's break down the truth behind the data and what it really means for the economy. Part 1. GDP. Growth is slowing fast. Let's start with the big one. Gross domestic product. The U.S. economy unexpectedly slowed in Q1, growing at just 1.6% annually, well below the 3.4% we saw the previous quarter and under Wall Street's expectations. That's a red flag. Consumer spending, which makes up nearly 70% of GDP, has softened, especially in durable goods like cars and appliances. And business investment is weakening, particularly in commercial real estate and equipment. This isn't a collapse, but it's a clear deceleration. And when GDP slows while inflation remains sticky, we have a problem. Part 2. Inflation and CPI, sticky, not subdued. Inflation has cooled from its 2022 peak, but the CPI report still shows elevated price pressures. Headline CPI is hovering around 3.5% year over year. Core CPI, which excludes food and energy, is still above 3.8%. The Fed's target is 2%. So even though prices aren't rising as fast as before, inflation is proving stubborn, especially in services like insurance, rent, and healthcare. Sticky inflation plus slowing growth? That's a recipe for stagflation concerns. Part 3. Unemployment. Still low, but cracks are forming. Now, the unemployment rate is still historically low, around 3.8%. But that number doesn't tell the whole story. Job openings are down from their 2022 peak. Wage growth is slowing. Labor force participation is flat. And temporary jobs, often an early signal of a slowdown, have declined for 11 straight months. Layoffs in sectors like tech, real estate, and logistics are ticking up. So while the labor market looks strong on the surface, there are growing signs of softening underneath. Part 4. Leading indicators flashing yellow. Beyond the headlines, there are other critical metrics economists track. Here's what they're telling us. ISM Manufacturing Index, still in contraction territory, less than 50, signaling weakness in factory activity. Consumer Confidence Index, declining, driven by inflation fears and job insecurity. Retail sales, growing modestly, but the pace is slowing. Consumers are getting cautious. Delinquency rates, rising for credit cards and auto loans, suggesting financial strain. Small business optimism, near decade lows, especially on future sales expectations, added up, and you've got an economy that's cooling faster than expected, while inflation remains a lingering threat. Part 5. What the Fed is watching closely. The Federal Reserve is in a tough spot. Their dual mandate is stable prices and full employment, and right now, they're stuck between the two. The Fed is watching. Core PCE inflation, their preferred gauge, still above 2.8%. Wage growth, particularly in services, credit conditions, which have tightened substantially. And the broader risk of financial instability from commercial real estate and consumer debt markets, expected 3 to 4 rate cuts in 2024. Now, many economists believe those cuts may be delayed or fewer than hoped, unless we see a sharper downturn. Part 6. So, what does it all mean? Here's the honest answer. The U.S. economy is at a pivot point. Growth is clearly slowing. Inflation is too high for comfort. The labor market is showing early cracks, and consumer confidence is slipping. If this continues, the Fed might be forced to cut rates sooner to cushion the slowdown. But if inflation doesn't cool, they'll be stuck waiting. even as the economy weakens. It's a narrow path, and any shock, oil prices, global conflict, debt default fears, could knock us off course. Final thoughts. The U.S. economy isn't crashing, but it's definitely cooling. The data shows a system under stress. Consumers are stretched, businesses are cautious, and the Fed is walking a tightrope. Pay attention to the next few CPI prints, job reports, and Fed meetings. Because if the slowdown continues and inflation remains sticky, policymakers may be forced to choose between economic pain and inflation credibility. Either way, the easy part of this economic recovery is over. If you found this breakdown helpful, subscribe to Finance-Related 101. We cut through the noise to explain what's really going on in the economy. Thanks for watching, and stay sharp.